Imagine your garage sale where you have a bunch of items for sale, but no one wants to buy them. I guess what you will be doing is to lower the price of each item so it can be bought, right? In a bad market, investors are nervous and hesitant to buy stocks because they think they might lose money. This can cause stock prices to drop, which can be a problem for people who have invested their money in those stocks. Think of it as a roller coaster ride, where the market is going down instead of up. Today, I will be sharing with you an insight from one of the most well-known financial analysts, as he talks about why 2023 is another bad year for markets. The person that I'm talking about is Fred Hickey. Before we proceed with the discussion proper, let me first introduce Fred Hickey to you. He is a well-known financial analyst and editor of the investment newsletter, The High-Tech Strategist. He is also known by the nickname The Bear, due to his often bearish outlook on the stock market. For 30 years, Hickey has been writing his newsletter and is highly regarded for his insights on the technology industry and its impact on the stock market. Now, Hickey has been pointing out that 2023 is going to be another bad year for markets. Do you have any idea why? Well, according to him, one of the reasons for this is the super bubbles. A super bubble refers to an economic bubble that occurs on a much larger scale than traditional bubbles, affecting entire sectors or even the entire economy. A bubble is a situation where the prices of assets, such as stocks, real estate, or commodities rise to unsustainable levels due to speculation, hype, or other factors, and then crash when investors realize that the prices are not based on the true value of the assets. Imagine a toy that's really popular and everyone wants to have it. The toy store only has a few in stock, so the price goes up because people are willing to pay more to get it. Eventually, more toy stores hear about how popular the toy is and start selling it too. The price keeps going up because more and more people want it, and some people start buying it just because they think they can sell it for even more money later. But then, something happens that makes people stop buying the toy. Maybe a new toy comes out that's even more popular, or people realize that the toy they paid a lot of money for isn't really that great. Suddenly, there are too many toys on the market, and not enough people who want them, so the price drops quickly. This is the idea that Fred Hickey emphasized in one of his talks. He is afraid that when super bubbles drop, it drops more than 50%.
In 2007-8, and that market top, you were 105%. So you can see how high we got. It was insane. It was a super bubble. And when super bubbles pop, they don't just go down a little bit. We're down on the S&P, and it's up here today. We're down on the S&P only in the teens right now. And that's not exactly bear market action. Super bubbles drop 50% or more.
Furthermore, a super bubble can occur when multiple smaller bubbles merge, or when there is a widespread mania or euphoria that fuels a bubble across multiple sectors of the economy. In a super bubble, prices of multiple assets can rise to astronomical levels, creating a bubble that is much larger than any individual bubble. One of the most notable examples of this is the dot-com bubble that occurred in the late 1990s and early 2000s when investors poured money into internet-based companies with the belief that they would revolutionize the economy. As a result, the stock prices of many of these companies skyrocketed, leading to massive valuations and wealth creation for some investors. However, many of these companies were not profitable and were relying on speculative investment to keep their businesses afloat. This led to a collapse in the stock prices of these companies, and many of them went bankrupt, leading to significant losses for investors. This 2023, Hickey foresees a super bubble because, for one, nowadays, we observe that the prices of assets become decoupled from their fundamental economic value. Just like having this rapid rise in housing prices throughout these years, with some properties even doubling in value within a few years. However, the underlying economic fundamentals, such as incomes and employment rates, do not justify such high prices. And so, easy access to credit, lax lending standards, and speculation fueled the growth of the housing market, leading to the decoupling of housing prices from their true economic value. When the housing bubble eventually bursts, it will have a ripple effect throughout the entire economy, leading to widespread financial distress and a global economic downturn. Another thing that Fred Hickey has told people is that more and more companies will have layoffs in their people. It may not be a big problem before, but certainly this is going to be a problem this year, according to Hickey.
We've seen a lot of layoffs in tech so far, but not in the major part of the economy, and I think they'll come. The only thing that does help is the shortage of workers, so that that will keep companies from laying off as many people as they would, but they'll have to, and we're already seeing that. I mean, Dell's laying off people as well as a result going forward in the last conference call here, and a lot of others will.
Fred Hickey said that laying off people is rooted for two reasons. It can be that there is a current economic downturn inside the company, or that there are technological advancements. Why? I'll tell you no, so listen carefully. For the first point, when demand for a company's products or services decreases, it can lead to a decline in revenue, making it difficult to maintain the same level of workforce. As a result, companies may resort to cutting costs, which may include layoffs. One example of an economic downturn that led to layoffs was the global financial crisis of 2008. The crisis was caused by the collapse of the housing market and the subsequent fallout in the financial sector. As a result, many businesses were affected, and demand for goods and services decreased significantly. Companies across different industries were forced to cut costs to survive, including reducing their workforce through layoffs. Second, the rapid advancement of technology has been a major driver of change in the job market, with many jobs becoming automated and requiring new skills. Technological advancements have enabled companies to be more productive, efficient, and cost-effective. However, they have also resulted in job losses as certain roles become obsolete. The impact of technological advancements on job loss is not limited to the manufacturing industry. The rise of artificial intelligence and machine learning is also having a profound effect on the job market, with certain roles becoming redundant or requiring new skill sets. For example, the use of chatbots and automated customer service systems is eliminating the need for certain roles in the customer service industry. A bad market can have devastating effects on individuals, businesses, and the economy as a whole. From economic recessions and stock market crashes to high inflation and unemployment rates, the consequences of a bad market can be far-reaching and long-lasting. However, there are steps we can take to mitigate the impact of a bad market and work towards a more stable and prosperous economy. These may include policies such as fiscal and monetary stimulus, regulatory reform, investment in infrastructure and education, and support for small businesses and entrepreneurs. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Zoo channel. I'll see you in the next one.